Do you want to reduce your energy bills? Or maybe you want to use greener energy? Go solar and get a discount. Right now, Which members can get a 7.5% discount on solar panels and their installation if you use Heatable, a Which Trusted Trader approved service. You can also include a storage battery and EV charger, handy if you're looking at making the switch to an electric car. To make use of this exclusive offer, simply head to which.co.uk/solar-offer. That's which.co.uk/solar-offer before the 30th of September 2025. And if you're not already a Which member, you can grab a year's membership for 50% off the usual price. To do that, go to which.co.uk/podcast offer to get involved. Start your solar journey today. Go solar and get a discount with Which.
Having the right amount of money set aside is crucial for when life throws you an unexpected curveball. But how much do you need, and what do you actually need to be prepared for? Welcome to Which Money. Hello, I'm James Rowe, sitting in for Lucia Ariano this week, and joining us in the studio, it's a warm welcome back to Which Money Deputy Editor Sam Richardson. Welcome back, it's been a long time.
Yeah, quite a while, thanks James.
Good to have you back. And joining us down the line is Head of Personal Finance at Hargreaves Lansdown, Sarah Cole. Sarah, how are you?
Oh, very good. Just coping just about with the weather.
Yes, aren't we all? We've got plenty to get into today as we talk about trying to prepare for when we get a bit of a financial shock, a bit of a curveball in life, shall we say. Sam, do you think enough people are actually aware of almost how much they actually need to have set aside or need to prepare for when we get these unexpected financial shocks?
It's a really tough one. I think people are really aware that they need emergency funds, but just don't have them. So I had a look at figures from the Financial Conduct Authority. They do a big study every so often, and 10% of adults they found had no cash savings at all.
Really?
And another 21% had less than £1,000. Now, compare that to, we recommend for your emergency fund, you need 3 months' worth of expenses. Not 3 months' worth of your income, but your actual expenses. I'd say for almost everyone, that's likely to be over £1,000. So there's a huge chunk of people that just don't have this money in place. But I do think in many cases, because they can't afford it, as opposed to just thinking, oh, nothing could possibly go wrong.
Do you think there are also people on that other side of the fence, though, where they think, well, I don't need to prepare for that? It's not just because they don't have the money. They may well have the money, but they like to just spend it and think, oh, what's the worst that could happen?
Yeah, possibly. And people always think, well, I've got a credit card, so I could use that if I needed. But we do, seriously recommend having the emergency fund in place. Part of that, actually, even if you are quite wealthy and say you've got quite a few investments, part of the emergency fund is actually, well, you might not want to sell your investments to deal with a very short-term expense. That emergency fund, in a way, protects your other kind of wealth-building strategies. So, you're never too wealthy for an emergency fund. I'd say that on the other end of the spectrum.
And Sarah, to bring you in then, when we talk about sort of financial shocks, they could be personal, couldn't they? It could be a case of you lose your job or your car has to go into the garage, and we suffer these kind of shocks. But we also have these big financial shocks that impact everybody. We've seen a few in recent years, haven't we? Like the war in Ukraine or the mini budget a few years ago. We've seen a few recently, haven't we?
Yes, and one of the things that can happen, for example, is if you are in retirement and you're using income drawdown, and you get a shock in terms of investment, that can be something that, a lot of people at the time were saying, well, my investments have fallen within my pension. What do I do? And that's the kind of time when having emergency savings is so important. So we actually kind of building on your kind of general rule of thumb. So the kind of rule of thumb we work to when you're working age is somewhere between 3 and 6 months. And the reason you have a sort of a nice spectrum is that some people will have lots of people who rely on them. So, if you can't work, for example, because somebody's ill in the family, or, you just need to support somebody else, then it helps to have a bit more of a cushion to fall back on. But then we say in retirement, you should have actually about 1 to 3 years worth of essential spending in retirement. And that's for exactly this reason, that if you have sort of issues to do with drawdown, you can say, right, well, that's fine. I won't touch my money while markets are down, I won't eat into it, because the problem is if you eat into it, it's much harder to build back. I will actually just draw on my emergency savings for a bit, and then I can top it up when the markets have returned. So it gives you so much more flexibility for dealing with these shocks. But yes, as you say, small shocks, lots of small shocks that do happen to people. We did a piece of research and asked, have you had a shock in the last 12 months? And the vast majority of people had some sort of expense out of the blue. But there are also these bigger picture things which are hard to sort of foresee, because they kind of hit everybody out of the blue. I mean, it's not that long ago since we had the sort of COVID crisis, which caused that problem.
And they can last quite a long time as well, can't they? I mean, I was just reminding myself around the base rate when we had the mini budget a few years ago, and that base rate kept creeping up and up and up, as did inflation, once we had the war in Ukraine as well. So it's not always that it just hits 1 month and it gets back to normal. It can last, 2, 3, 4 years even.
Well, yes, and it's one of the reasons why we say, when you look at how much, say, 3 to 6 months worth of essential spending is, it's quite a big chunk of cash, and people can be quite surprised. So very roughly, we sort of do a sort of, very rough average household. Roughly, your expenses are somewhere around £2,000 on average. And so you're looking to have £6,000 at least in your savings account, which is just a huge amount of money for a lot of people. And you can ask, well, why on earth would I need that much? But actually, it does protect you. So say you have something out of the blue, and you've got sort of time to build back. Because if you have, what we tend to find, it's not one thing that goes wrong, it's like several things that go wrong. And it gives you that protection then that you can cover those things as they come up without worrying about the fact that you completely used up your savings and you've got nowhere to go.
Yeah, just to build on Sarah's points as well, the point of the emergency fund can also help prevent long-term damage. So say you miss a payment on your credit card, on your mortgage, that's going to hit your credit rating, could make it more difficult to get another card or a loan in future. Whereas if you can just eat into that emergency fund, hopefully those kind of bad times will pass, things will improve, you can build back up that fund without worrying, oh my God, my credit rating is wrecked.
So you're almost trying to protect yourself. Almost you've got that emergency fund. It's there to be used for an emergency, but protecting yourself as you go along. You mentioned mortgages. I do want to touch on mortgages because we have seen in the past, haven't we, very recently, I mentioned the mini budget again because it's something that had a big impact on people who were taking out mortgages, where their interest rate just went up and up and up and up right before they were about to take out a new deal. And that can be a big worry for people, can't it? What's the best advice as if something like that is happening again in the future? Is it best to try and beat it and go earlier, or what's our best advice here?
This is a really typical one. I mean, this is quite a small group of people who would be, say buying a home or something just around the time of the mini budget, where that is a really difficult one. I would say once you've got your mortgage offer, in most cases, that is valid for a certain time period, including the rate, and it won't change. So then you've got to get your property purchase completed within that time. I mean, I bought a house last year and it was a nightmare, and I never thought we'd come close to the end of the mortgage offer period, but we did. I think the broader issue with the mini budget was people's mortgages going up, either because they want a tracker rate or a variable rate, and it could change all the time, or because they'd been on a fixed term, they'd taken it out during, it's strange to say that 2020 was the glory days, but they were if you were taking a mortgage because you paid almost nothing. Say you had a 5-year mortgage then, it's expiring this year, your rate could be easily more than doubling, could be tripling or quadrupling. I'd say in that case, talk to a broker early. Don't wait till the mortgage is close, the fixed period of the mortgage is close to expiry. Understand your options. Brokers are wonderful at doing kind of budgeting calculations. That's why they insist on these very tedious phone conversations about, how much do you spend on clothes per month? And it's like, well, I buy them about once a year, so I don't really know per month.
Is that an honest answer from you, Sam, or is that do you spend a bit more than that? Sarah, do you hear from people about this kind of thing where, they've got a mortgage coming up soon and they almost want to try and bite the bullet and get it done and try and lock in a deal early just in case the rates start to creep up again and they get bitten again?
It's definitely a really good idea, particularly at the moment. So what you've got going on in the mortgage market at the moment is quite weird. So we've seen lots of people cutting rates because overall we are expecting rates to kind of fall in future. So the market is pricing in a couple more rate cuts. But at the same time, there's been this sort of weird thing going on in bond markets. And to, not to be unnecessarily complicated, but basically bond markets are driven enormously by what happens in the US. So the fact that, some of the policies coming out of the US have been so unpredictable, it has pushed up bond yields in the US, which has pushed them up around the world, which tends to put upwards pressure on mortgage rates. So we've got this thing at the moment where we are seeing them come down, but there is the chance that they'll occasionally go up and down again. So there'll be a lot of sort of short-term movement. And in that kind of environment, it's a brilliant idea. If you're coming up to remortgage, usually you can, a few months out, get yourself a quote for another remortgage and lock it in. And that way, if mortgage rates were to rise, then you've got that deal locked in. And if they were to fall, then you can just go and search for another mortgage elsewhere. So you're kind of hedging your bets based on what Donald Trump wakes up and decides to do the following day.
So try not to predict it is a good way of looking at it. Try and get something locked in. If they go up, you've got it. If they come down, you can get something a little bit lower, which obviously works in your favour.
Saving for retirement can feel daunting. The same goes for managing your money once you've stopped working. That's why we've created an 8-week newsletter series breaking down what you need to consider, both pre and post-retirement, into bite-sized chunks. If you sign up to our free retirement newsletters, for 8 weeks we'll send you an email full of expert guidance to help you take control of your retirement planning and give you the confidence to make smart decisions. We'll help you get to grips with your pension, teach you how to boost your income, and explain more about care options. It doesn't matter when you sign up either. Your 8 weeks of advice will start whenever you sign up. So what are you waiting for? Head to which.co.uk/retirement newsletters, all one word, to get up to speed on everything you need to know for retirement.
Sarah, a little bit earlier you mentioned the market, and just now you've mentioned the market as well for our investments. And this is another big one, isn't it? Because I think a lot of the time here on the podcast, we often talk about investments, and a lot of the advice tends to be you've got to just try and ride out the storm. Is that always kind of the best advice if you are in it for the long term?
Yes, I mean, I think the first thing to do is when the going is good, when everything is fabulous and you're not worried about anything, just think about diversification, which is basically all it means is spreading your investments over different things. So it can be over different assets, so bonds and shares and things like gold, over different geographies, so around the world, and really making sure that you've got this decent spread of assets that kind of reflects the sort of things you want to achieve with your money. Now, you can do that yourself. You can do it through a variety of different funds, or you can maybe go for multi-asset funds, which do that for you. They kind of invest in a variety of different things. So as long as you're in that position, when these things happen and you kind of get hit, then you just think about your longer time horizon. You know that you're investing for the long term because, investing is something that's for 5 to 10 years or more. You know that there'll be ups and downs along the way. That's all part and parcel of investing. It's all completely normal. And it's just about not panicking, no knee-jerk reactions, just hold on tight. The risk you have is that people think either, oh my goodness, I can't cope, I'm selling out. And then you crystallize your losses. So you basically lock in your losses. And the other thing some people think to do is, well, maybe I can be clever and time it so I can sell out now and buy back later. And you're far more likely to come a cropper than you are to actually successfully do it. So it's worth just holding tight, not making any sudden movements, and knowing that over the long term, the ups and downs will even out, and you will sort of move over to long-term growth.
It can be tempting though, can't it, Sam? In some circumstances where you look at that graph of the market and you see it almost taking a nosedive, or it looks to be on a short term at least downward trend. It can be tempting to just try and take all the money out just so you don't lose. But as Sarah's saying, you kind of have to be in it for the long term, don't you?
It's really tough. There's so much news out there about what's happening in markets. I think there's almost an argument, if you're a long-term investor, do you really need daily news about the performance of your investment? Should you really be, say, checking your investment platform account every day? So I would urge people to consider, do I need constant views? I would say, well, maybe look at regular reviews at a decent time period and only then make changes. And even then consider, why am I selling at the bottom of the market here? I would also maybe argue, it seems like we're in a very volatile year and there's a lot of things happening. If it is causing you a huge amount of stress to see these wild variations in your investments, perhaps over the long term, I'd be interested in your views on this, Sarah. should you be opting for less volatile investments? I mean, I'm reluctant to say that people should go for very conservative, kind of safe portfolios because you won't make as much money that way. But if it really is keeping you awake at night, I would say to people, well, maybe consider moving from stocks and shares to bonds. Not for all of your investments. Again, you do want to make money in the long term, but if it's really causing kind of mental health stresses for you, there are things you could do.
I mean, I would definitely say it's all the key is that diversification, because as you say, any kind of movement you have to think quite carefully about. So, if you were, for example, to have moved into government bonds, before the beginning of this year, you might have thought, oh, I've got a nice, safe, nothing really happens to government bonds. And of course, they've moved a lot over the last year. So I think it's matching your risk profile to the things that you're holding. I'm thinking about, and I mentioned these multi-asset funds. That's where you're sort of putting it in the hands of someone who, look at their objectives. So their objectives might be, we aim to beat inflation and to lose less at times of volatility. Well, that might be your aim. So that might work out really well for you. Another thing we find is if somebody is really struggling, if you do lose sleep over losses and you are worried about it, but you know that you probably need to be investing for the long term, that's the kind of time when getting some advice can actually make a huge difference. Often getting advice is really about that sort of having someone to almost hold your hand through these processes. I mean, I talked to one of our advisors during the sort of most recent volatility, and they said they get loads of emails from people who say, I know we talked about this, I know we modeled this, I know you've told me I just sit tight, but can you promise me I'm doing the right thing? Just so that they've got that reassurance, they then can sleep at night because they know that they're doing the right thing and they've got a plan in place.
I think reassurance is the key here, isn't it? Especially for, people who are new to investing. We see a lot more people who are getting into the game now, especially with a stocks and shares ISA. So for people like that, I'm one of them actually. Just this year, I've opened a stocks and shares ISA. And, for me, it's good to hear that this sort of reassurance to say, look, you've just got to ride it out. Try not to look at it too often, otherwise you'll end up scaring yourself. Just ride it out.
Yeah. And also, before we move on for investing, Sarah, I'm interested in getting your views on gold, because this seems to always come up, and the value of it has gone up hugely in recent years, but then actually it's not quite flatline because it moves around all the time. But the last few months, you wouldn't have made a profit necessarily. How do you guys approach gold? What part of a portfolio should it play, if any?
Well, it often plays a sort of a small part of people's portfolio. I think one of the things people find really confusing about gold is that it's called a sort of safe haven asset. And people need to know that's not about investment performance. That's about, that's actually about an inflation hedge, because they have tended to outpace inflation over time. So it's got nothing to do with volatility, and gold can be really volatile. And of course, we've seen those prices really hike up. And of course, when they're riding high, there is that sort of increased level of risk. So I think it's an important part of a lot of portfolios. If you look at some of these funds that hold lots of different assets, it will be part of the mix. But, it's not just because you hear something is described as a safe haven, really don't think of it as safe. That's not what it means in this context. It can be a sort of a useful hedge against inflation, but it's definitely not. I wouldn't recommend you go and sort of go out, buy a load of gold bars and stick them under your bed. That's not the way to go.
But if you somehow do that, please tell your home insurer. They need to know, and they probably will hike your premiums. But imagine if you lost all of that gold.
That's a good segue, Sam, because I do want to talk about insurance, specifically home insurance, because I remember on the podcast, I think it was about 6 months ago, just before Christmas at least, when we released our new recommended providers for home insurance, we'd seen that premiums had been creeping up and up and up. And it's almost as if we don't see these price increases because I guess we're so used to seeing car insurance go up and we spend a lot more money on car insurance. But home insurance, when it goes up, it can start to add up, and especially if you're not actually getting the right amount of cover.
Yeah, so car insurance prices rose and rose, and then they seem to have peaked, and we hope they will come down from there. Home insurance prices continue to rise, and they can be quite considerable, quite a few £100s. I will say with people, okay, we have these reviews you can go look at. I would use them alongside a comparison site, and you will find in some cases that a cheaper policy has better cover, especially perhaps, don't be enamored by brand names here. Look at the actual, policy scores we have. In general, you do get what you pay for. So, if you you spend very little on an insurance policy. It may have the very basics. And there is something that makes me nervous about that, in the same way that people who increase their excess, the amount that you must pay when you claim, in order to reduce their premium, the amount you regularly claim, also makes me nervous, because you're essentially trying to reduce costs in good times, but they'll be higher in bad times, which seems to me the opposite of what insurance is for. So if you are going to cut cover or raise your excess, really think, like, could I afford to claim? How does it compare to my emergency fund? Also consider, the most common claim, I believe, for home insurance, might be wrong here, but I think it's accidental damage. And that's actually excluded from a lot of cheaper policies, probably because insurers know, well, we'll probably have to pay out for that. Well, consider, if my child does push my TV over and it smashes, can I just buy a new one straight off, which some people can, but do be careful about trimming cover.
This is another thing, isn't it, Sarah? It's about making sure you've got the right thing for you. And I'm going to use the word cover because that's what we're talking about here. But it is making sure when you take out a policy, you read that very boring policy document just to be sure that if something bad happens, if there is a shock in your house, you do have the right cover that you thought you'd signed up for.
Yes, and it's a big ask. It's a really big ask. So, I know from personal experience, I bought some travel insurance, and one of the key policies that affected me was on page 32 of the small print. So it's a lot to ask people to do, sit down and read the small print, but really it's very important. The other thing is to make sure that you're disclosing everything correctly, because when something, when disaster strikes, when something happens and you need to claim, the last thing you want to do is suddenly find that because you ticked the wrong box, or you weren't sort of reading something carefully enough, or you've made assumptions about your own house. For example, you might need to calculate what percentage of your roof is flat. Well, it's not something that anybody relishes doing, but actually taking the time to do it does mean that you are then properly covered if something goes wrong.
Sticking with insurance, I want to talk about life insurance, because for me, when I took out my first mortgage around this time last year, this is something that the mortgage broker was offering. And I remember thinking, is this something that I can just avoid, or can I just do this by myself? But I mean, straight up, that's not, we shouldn't advise that. You will, more likely than not, you will need some sort of life insurance cover, right?
I don't know, maybe because I'm young and naive. I still think it's a personal financial decision based on do you think you have, say, dependents to support if you were to pass away. I think life insurance is a lot more flexible than people think it is. I think a lot of people think of it, okay, I'll have it my whole life and it's only, to leave an inheritance to people, whereas actually you can get life insurance that only lasts for a particular term. Say when your children are young, you could have it, you could have it for 18 years, from the birth of your final child, or you could have it to pay off your mortgage. So again, only for a certain term, and reducing the term will reduce the cost of the life insurance. So I would think about the kind of use case for it. And I would also say in that specific situation, you've been offered it by your mortgage broker. Why do you have to buy from them? Why not a third party? We almost always recommend going to third parties than the first person who approaches you about it, because it probably makes quite a lot of money for them. The convenience for you is pretty minor. It's just filling in one form, then the other. But it is worth, if you do think you have dependents to support, then it is worth getting this. Don't leave it at the bottom of the admin pile forever. Also, for the basic fact that the price increases as you get older. So, you leave it a very long time, it will cost you a lot more.
Sarah, what are your thoughts on this?
Well, it's really interesting because to hear you talk, because basically most people don't have enough life insurance. So we do a piece of research, it's the HR Savings and Resilience Barometer, and overall it shows that only 43% of people have enough life insurance. And even if you're single, there might be reasons why you want to insure your life. So, for example, some people will think about, when their funeral cover, they might not want to get specific funeral cover. They might say, well, if I have a life insurance policy, that'll pay out in trust to somebody else, and then they can cover the cost of the funeral out of that. So there are other reasons why you might have it. But I think one of the really things, you talk about dependents, those people who are most likely to need life insurance don't have it. So they're the least likely to have it. So actually fewer than a third of parents have life insurance cover, and fewer than 1 in 10 single parents. Also, those people who don't have enough emergency savings, they are also likely to fall short. So there is a huge life insurance gap. And, life insurance is surprisingly affordable. And often you can look at whether or not you can get it through work, because those things can actually really help close the gap. But I think it's when you're looking at how much life insurance, often people will just pluck a figure out of nowhere and think, oh, roughly, I don't know, £100,000. Actually think about what it will cost to bring your children up. And you mentioned the age of 18. I have older teenagers now, and I'm thinking, thank goodness I didn't stop my insurance at 18, because I know they will need support a bit later in life as well. So there is that sort of plan ahead, work out what it will cost to sort of look after your children up to that point. And then also, what it will cost to sort of pay off all your liabilities, so your things like your mortgages and things like that, and add that all together, and then look at exactly how cheaply you can get your life insurance. And I think you'll be pleasantly surprised. And I think it's that peace of mind when the worst possible thing happens, then you're not plunged into this awful financial situation as well. You've got something that will protect you.
To wrap up then, shall we touch on power of attorney and wills? Because I guess this is kind of one of the last things you might actually end up thinking about, but it could be one of or two of the most crucial documents you could really need, Sarah. Just quickly, why is it so crucial to have these two documents in place?
So with your lasting power of attorney, that basically you have two types. You have one that covers your finances and one that covers sort of health decisions. And it's really important that you set that up way before you need it, because you actually need to be able to make decisions. You need to have cognitive ability to make decisions in order to set it up. And so therefore, it's too late when things that you've got maybe already in decline. So I would definitely say when you're thinking about your will, also think about your lasting power of attorney. And it means things like, your children help you pay for care, or they can sort of make, the right people are making the right decisions about your life at the right time. You can, if you don't get around to it and you haven't planned for it, there are things that your family can apply for deputyship, for example, but that will be more expensive. There's a time delay, and also their powers are quite limited. So I would definitely say look into that sooner rather than later. And making a will, it's if you've got complicated life, extended complicated families, of course you know already how important it is to have a will to make sure the right people benefit. But even if you have very straightforward sort of circumstances, it's vitally important, because you may not be fully aware of how the rules are set up, so how your estate is divided if you don't make a will. So say, for example, you have over £322,000 in your estate, you might just assume, well, the rules probably means it goes to my spouse. Well, they don't. It means that half of it goes to your spouse and they share the other half with any children. So it can actually cause complications even when you think things are incredibly straightforward. So I would say, nobody wants to make a will because nobody wants to think about dying. But, treat yourself, get yourself off, really as soon as you have children, at the very latest, you really need to be drawing up a will.
And we have a service for both of these here at Which. We'll pop some links in the show notes so you can find out a little bit more. But Sam, it seems like it would be incredibly complex if you don't have one of these in place. Based on the things that Sarah was saying, it just proves why it is so vital to have one, just to try and cover all bases and make things as smooth and as simple as possible.
Yeah, I think the power of both of them are such. They don't have to be that much work, especially if you do need either a will writing service or a solicitor's advice to help you with them. I would just add with wills, once you have one, you may need to update it. If you get married at the moment, I believe, I might be wrong here, but I believe that actually invalidates your old will. And of course, if you want to include new children or grandchildren, so it's not just something you can then leave
in a drawer and forget about it.
Do pay attention to it. And also, if it doesn't sound too obvious to people, make sure it's accessible as well and quite easily for your loved ones and executors. With digital documents especially, we forget that no one else can access them, and sometimes it's worth just printing it out and putting it somewhere.
I'm just going to add that one of the things people don't think about that can be really valuable is a letter of wishes that you keep with your will. And that can be really valuable because if you've made decisions in your will that you don't particularly want to lay out for everyone to see, because obviously wills become public, you can then explain things in your letter of wishes. And you can also change your letter of wishes much more easily. You can lay out things like your funeral plans, you can lay out specific bequests. It can give you a lot more freedom to make changes without going through the whole will writing process again. And it can also just help be a sort of an easier way of communicating with your family after you've gone, so they've got something that's a bit more personal from you.
And just to wrap up then, from both of you very quickly, based on everything we've spoken about so far, just one final bit of advice or something just to take away. I don't want to sort of lead you both on and put words in your mouth, but it sounds like preparation is key for all this, isn't it?
Yes, absolutely. I mean, now I'm a ripe old age of 50. So many of these disasters have happened to me, bereavement, needing to use power of attorney, all of these things, and at each stage, the preparations that someone has put in place has been so vital for those they leave behind. So you might never get to appreciate in your own lifetime the difference that these preparations make, but they really will change people's lives.
On a more humdrum note, go away and set up a savings account, an instant access savings account that ideally is not too easy for you to get out from your current account, as in perhaps from a different provider. Make sure it has a decent rate and build your emergency fund. Don't think, okay, I've got the money in my current account now, because you might need that for something else. And if you just start doing it today, even if you can only put a little bit in to start, just make regular contributions, and you might, very much need it one day.
So a separate account that's just for the emergency fund. You never touch it until you need it. That's the key.
Yeah, and know how to access it quickly if you do.
Very crucial. Well, we've covered loads off today and plenty of great advice. Sam, thanks for coming back on the podcast. Great to have you on.
Thank you. Yeah, wonderful to be back.
And Sarah, brilliant to have you on as well. Thanks very much.
Oh, it's lovely to be here.
Thanks for listening to this podcast from Which, the UK's consumer champion. You can find plenty more advice about what we discussed today in the show notes. There you'll also find a link to become a Which member for 50% off the usual price, an offer exclusively available to you, our podcast listeners. Joining Which will not only give you access to all of our product reviews, our app, one-to-one personalised buying advice and every issue of Which magazine across the air, but you'll also be helping us to make life simpler, fairer and safer for everyone. Don't forget to hit subscribe wherever you're listening. That way you'll be notified whenever we release a new episode of Which Money, Which Shorts, or another podcast that we make for you. And if you want to get in touch with us, then follow us on social media. We're at Which UK, or you can drop us an email to podcasts@which.co.uk. See you next time.
If you're enjoying this podcast from us here at Which, then why not become a Which member? Right now, we've got a special offer, especially for podcast listeners, meaning you can choose any of our 3 membership tiers for 50% off the usual price. Starting at just £39.50 for a full year, you can get Which magazine delivered direct to your door. For the same price, you could also choose a digital Which subscription, giving you access to all of our product reviews, the Which app, and the digital edition of Which magazine. What's more, you'll also be able to use the Ask Which service for personalised one-to-one buying advice. Or why not get a full access Which subscription for just £49.50 for a full year? Don't forget, that's 50% off the usual price. To join Which or to find out more, just head to which.co.uk/podcast offer. That's which.co.uk/podcast offer. Or click the link in the description for today's podcast for 50% off a Which annual subscription.